Welcome, everybody. Thank you for joining me. Hope everybody is staying safe and healthy. My name is Jake Franklin, and I'm going to give you a quick overview of the tax impacts of the CARES Act. So, with that, let's go ahead and get started. We'll first get started with the individual provisions in the CARES Act. The one that everybody is talking about, or I have to assume everyone is talking about, considering I've been isolated in my home for a couple weeks, is the recovery rebate. And what that is that is a direct payment to individuals, and it is $1,200 each for basically each person, right? So a single taxpayer is going to get $1,200. A married couple filing jointly is going to receive $2,400. And then each dependent child on a tax return will be worth $500 with this rebate. So it will have an income phase out range. That range will be for single taxpayers over $75,000, and for married taxpayers over $150,000. So essentially, what happens is as the income exceeds those amounts, for each $100 that it exceeds those amounts, then the rebate is reduced by $5. So a single person with no children will be fully phased out of the rebate at $99,000. However, if there are dependents on the return, it will take longer for that amount to phase out. So this is technically a refundable credit on the 2020 tax return. However, they're sending out the rebates early as an advance of that credit. They're using the income thresholds and the number of dependents claimed in determining that 2020 advance amount based upon the 2019 tax return. And if that 2019 tax return has not been filed yet, they will be using the 2018 tax return to determine those amounts. The next item is retirement plans. So they've loosened up and provided some additional ability for individuals to withdraw money out of retirement plans. So first of all, if an individual is affected by COVID-19, so basically that means if they have the virus, or someone in their family has the virus, or if they lose their job or face reduced hours or are somehow affected by the virus, those individuals are eligible to withdraw up to $100,000 from their retirement account, even though they're under the age of 59 and a half. It'll be considered a qualified distribution if they meet certain COVID-19 eligibility requirements. So they won't be subject to the 10% penalty. It will still be subject to income tax. However, that income tax can be taxed over 3 years. And then also, in what I consider to be a kind of interesting twist, people are able to withdraw up to 100,000, or I should say the affected individuals of COVID-19 are eligible to withdraw up to $100,000 from their retirement account. And so long as that $100,000 is redeposited in the retirement account within 3 years, that amount is going to be, in essence, treated as a non-taxable rollover. So generally, we have 60 days, right? So if we take a distribution from an IRA account, and as long as the amount is back in within 60 days, then it is treated as a rollover. Now Congress has given us a 3-year treatment on that for those affected by COVID-19. And then also there's a provision in there that sort of loosens up the repayment obligation for those who had taken loans from retirement plans. Essentially, if they were due in 2020, the Congress has given them a 1-year extension to repay those loans. So next, let's talk about charitable contributions. Congress created a new, what we like to call above the line deduction for charitable contributions in the amount of $300. So essentially what above the line means is that you don't have to itemize your deductions in order to be able to take it. Generally, charitable contributions are an itemized deduction, right? So we would either forego the standard deduction and claim itemized deductions, or if the standard deduction is higher, you essentially end up foregoing your charitable contributions. Now you're able to take the standard deduction, and in addition to that, take up to $300 of charitable contributions. Also, the adjusted gross income limitation for cash contributions to charitable organizations has been suspended for 2020. In the past, you normally could not give away more than one half of your income, right? So if someone were to make $100,000 in a year, any charitable contribution in excess of $50,000 would have been suspended and carried forward to future years. The Tax Cuts and Jobs Act that passed about 2 years ago moved that up to 60%. And now effectively for the 2020 year, Congress has pushed that all the way up to 100%. Additionally, C corporations are eligible to now donate up to 25% of their income, versus in the past, it's always been 10%. This is for 2020 only as well. And then this is probably only going to affect a few people listening, but the special food inventory contribution amount, that amount is raised to 25% for 2020 versus 15%. This is essentially like for grocers, or I guess it also affects potato farmers, where they donate goods to a food bank. There's an enhanced charitable contribution for doing so. So let's move on to business provisions. First, I should note the payroll protection loans. I'm not going to go into it. I'm actually not even going to cover those in this webinar. Yesterday, Harmony from Brady Martz published a webinar on our website called CARES Act, What Employers Need to Know. And she did a really, really great job of going through that. And I'm not going to reinvent the wheel. If you'd like to hear about that, I encourage you to go listen to her webinar. I do mention it though, because a couple of the things that I'm going to talk about here are affected by whether or not a business has taken one of those loans. And those two items are the employer retention credit, as well as the delay of payroll tax payments. So the employer tax credit, this is essentially a refundable payroll tax credit. And it's a credit of 50% of the wages that were paid to employees while the company was essentially shut down or was severely impacted by the COVID-19. So the wages that can be included in this 50% credit is the first $10,000 for each employee, including health benefits, and the period that the credit is available is between March 13th and December 31st. So employers will qualify for this credit, first of all, if they didn't get one of those payroll protection loans. But then also employers who had their operations closed by, I guess, what I would call an appropriate government authority, and or I should say, or employers whose gross receipts declined by more than 50% compared to the same quarter in the previous year. So between the time that the gross receipts reduced by 50 to the time that they climbed back up to 80, during that time, the employer is eligible. So there's different treatments between whether an employer has more than 100 employees or fewer than 100 employees. If there's more than 100 employees, the wages that are paid to those employees while they're not providing service to the employer. So the employee is at home due to COVID-19 shutdown of the business, and they are still being paid by the employer, those wages would be eligible for this 50% credit. And then fewer than 100 employees, it's essentially all wages paid to all employees of the employer during that time of suspension or significant decline in gross receipts. I think this credit is what a lot of people were hoping that sick pay, that family's first credit would be. This credit ends up being what a lot of people were hoping that would be. So, and then the next item would be a payroll tax delay. Again, subject to some limitations if you took a payroll protection loan. And essentially what it is the Social Security and Medicare tax, the employer's match of the employee's withholding, that amount can be held on to by the employer, right? The employer still needs to remit the amount that was withheld from the employee's checks, but the employer match portion can be delayed until and actually spread over 2 years. So it'll be due on December 31st of 2021 and December 31st of 2022. Another big change that'll affect a few is the change in the treatment of net operating losses. So I almost have to explain 3 different tax laws in order to make this make sense. But before the tax reform that happened at the end of 2017, net operating losses, so essentially business losses, could be carried back for 2 years for a claim of refund, or they could be carried forward for 20 years and they would offset future earnings. Those net operating losses were fully deductible against income, and there was some AMT limitations, but I'm not going to dive into that here. So what happened under the Tax Cuts and Jobs Act, so starting in 2018, is that these net operating losses that arose from tax years starting in 2018, those were not allowed to be carried back, right? So if I lost money in 2018, I couldn't carry it back into an earlier year. And not only that, but then also those losses they were not subject to that 20-year limitation, right? They could be carried forward indefinitely. What happens now during the CARES Act is essentially we rewind everything that just happened regarding net operating losses under the last tax reform. So any net operating losses that happened in the 2018 and 2019 tax year and 2020 tax year can now be carried back not 2 years, but they can be carried back 5 years. So businesses that had losses in 18, 19, or 20 will be able to go back and grab refunds of income tax paid in prior years to have access to cash. And then also through 2020, that 80% limitation where a net operating loss cannot offset more than 80% of income in a year, that is suspended through 2020. So one more item here that some people have run into, not everyone, is the excess business loss limitation. So this was created under the Tax Cuts and Jobs Act as a revenue raiser. And the idea is that business losses in excess of certain thresholds, so 500,000 for married, 250,000 for everybody else, are amounts in excess of that are effectively suspended. It only affects income that's taxed on a 1040. So this does not affect C corporations. It does affect owners of pass-through businesses like S corporations and partnerships. So this was a temporary limitation that it's set to expire in 2025. The losses that were in excess of those threshold amounts that were carried forward were essentially turned into a net operating loss to be used in a future year. And essentially what's happened under the CARES Act is they've basically suspended this loss limitation requirement for the 2018, 2019, and 2020 tax year. So any taxpayers that were affected by this in 2018 and 2019 will now be able to go back and amend those tax returns, and will be able to fully utilize those business losses and claim refunds. So, and one more item here is the qualified improvement property. Essentially, what this is this is a mistake made by Congress during the Tax Cuts and Jobs Act that they're now finally getting around to fixing. They've been talking about fixing this mistake for the last couple of years, and they've never been able to agree on fixing it. And so they were able to now attach this fix to this large bill and essentially do what they intended to do in the first place. So before the Tax Cuts and Jobs Act, we had these different carve outs for different types of real estate in the way that we depreciated them. So we had items like qualified leasehold improvements, qualified restaurant property, qualified retail improvement property, and essentially those got shorter depreciation lives. Normally, commercial real estate is depreciated over 39 years. These were afforded a 15-year depreciation life, and they also qualified for some faster depreciation write-offs. And then under the Tax Cuts and Jobs Act, what they were attempting to do was basically expand this beyond just leasehold restaurant and retail, and essentially give this same benefit to everyone. So basically every real estate improvement that's commercial, so not residential property, that's every improvement that's made to a building that's already existing and already placed in service. There's some other requirements like having it be the interior of the building, and having it, you can't change the structure of the building. There's different limitations, but essentially Congress's intent, as they explained in the joint explanatory statement of the law, their intent was this to be 15-year property, for it to be fully eligible for bonus depreciation, and essentially allow us to write this type of improvement off in a single year. But unfortunately, through a drafting error, they didn't do that. So essentially what they did is they took the leasehold restaurant and retail, and rather than giving it to everybody else, they ended up just taking it away from those people. So what happens is the CARES Act changes this back to the original intent, and it's retroactive. So those businesses that were affected by this drafting error in 2018 and 2019 are now eligible to go back and amend those tax returns and claim refunds for that drafting fix. So a couple other items here that I'm really only going to give quick lip service to because they affect so few people. One item is that if there's a C corporation that had paid alternative minimum tax in a prior year, the CARES Act allows for a faster refund of those credits that were generated by paying that alternative minimum tax. And then also there was a business interest limitation that essentially, if certain thresholds were met, could limit the deductibility of interest expense for businesses starting in 2018. And those amounts those limitations have been modified. They've basically rewritten the formula for a couple years, so that it's now going to allow some businesses to deduct more interest. So with that, again, my name is Jake Franklin. I'm a senior manager with Brady Martz, and I'd be happy to help if you have any questions. Feel free to reach out to me at the email and the phone number provided there. Also, make sure to check out our website for other COVID-19 business impact solutions. Thanks.